Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Karen Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
Okay, welcome to the Capital Conversations. We're back. I think Erik, is this our 10th episode that we've done of these?
This is our 10th episode, if you count the pilot.
Yeah. So what we're going to do today, we've been promising a recap of MicroCap. So Erik's going to talk about that. And then we're going to just hit the highlights of what we covered in the last 9 episodes, because we're going to start the next phase of where we're going to go is stitching it all together so you understand how the capital ladder works, what it means for entrepreneurs and investors to be able to, understand that flow, because when you want to get started, you want to get started right, because you know the direction that you're going. You got a good roadmap of where you're going to follow to get to where you're creating wealth by exiting the company through an acquisition or an IPO. So with that, let's just jump in. Erik, let's do our disclaimer.
All right. The information provided in this podcast is for educational and informational purposes only and is not intended as financial advice. The views and opinions expressed by the hosts and guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult a qualified financial advisor or conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risk and uncertainties. We do not guarantee the accuracy, completeness, or the usefulness of any information discussed. By listening to this podcast, you agree not to hold the host, guests, or any affiliated parties liable for any losses or damages that may arise for your reliance on the information provided. And there we go.
Yeah. Okay, so at Planet MicroCap in Vegas, that was like the third week in April. You were on a panel. Well, first of all, you like, for those that didn't hear the other ones, what is Planet MicroCap? And then you were on a panel, the true cost of being public, which is really relevant for all of the different things that we've been talking about. And for those companies out there that are struggling either with their transfer agent, with their EDGAR filings, with any of those kind of things that are putting their listed, and particularly in this current market of how tumultuous it is, that's the specialties of Mountain Transfer and Sterling Holdings and Coral Capital. So, so what is microcap? What's defined as a microcap?
So a microcap company, I believe, is any company with a market capitalization of less than $400 million. And that includes broad swaths of the NASDAQ and the NYSE Venture and pretty much the entire over-the-counter market. Planet MicroCap is a conference sponsored by Stock News Now, which friends of mine, Shelley and Bobby Kraft, run. It has evolved over the last couple years into what is, in my opinion, the premier investor conference in the country. The quality of the companies is, in my opinion, second to none, and it is basically, we're looking at a bunch of growth-orientated companies that are below 400 million in market cap, and almost all of them are traded either on a U.S. National Stock Exchange, meaning the NASDAQ or New York Stock Exchange, or are traded on one of the Canadian stock exchanges. And this year they partnered with the MicroCap Club, which is a online investor community of dedicated investors and fund managers who are really focused on high growth companies. And these are, I'll give you a good example. I talked to fund managers that had came in from all over the world. On Wednesday morning, I rode the elevator with a fund manager I was talking to who came to the conference from Cologne, Germany. No small trip for a conference of this nature. And afterwards, he said he was off to Texas to visit a couple of his portfolio companies that were presenting at the conference. So it was really a good time.
let me ask you this. So if they're presenting as at the conference as a public company, and I know we kind of talked about this in one of the episodes, which we'll, I guess, highlight here in a second, how public companies raise capital from their own investors as others. So are these PIPE funds, private investment into public entities? Or are they hedge funds that are buying public stock? I mean, or are they pitching something different? Like, how are they pitching to raise capital at this conference from these fund managers?
So a lot of the companies at the conference are presenting for the benefit of investor awareness.
Okay.
And what I thought was really special about this conference is we were one of the sponsors of the conference. So we had a booth at the conference, and we talked to a lot of people. But you're either a sponsor, a presenting company, or you're an investor at this conference. This is one of the few conferences where I believe the investors outnumbered the presenting companies and sponsors by about 2-1.
Oh,
So it was a
wow.
huge crowd of investors, and a lot of these guys are basically running dedicated microcap funds. These are funds that are dedicated to investing in small and microcap companies that are looking for good quality long-term investments that are growing their earnings. And they've got a pretty strict set of principles that they feel provide outsized returns, returns that are above what you get in a large cap or a blue chip, and particularly on a risk adjusted basis. And then there's a lot of individual investors running around. I regularly see a gentleman at this conference that I spoke to 30 years ago when I was a retail broker, and he's been doing his brand of investing ever since. So it's a phenomenal group. But these companies, they want to keep reaching new investors, keep their existing investors informed, and continue to maintain what they feel is a stock that is fairly priced for the market.
Okay.
And it just doesn't happen organically.
Yeah, there's just too many companies out there, and the noise of all the companies, and particularly those that aren't the big ones that might be in headlines or something like that. This is a way for them to find value investments in the stock market.
Yeah, and there are companies out there looking to raise capital. So there are numerous investment banks that also co-sponsor the conference, and they are there to meet with these companies looking to raise capital. And it's a very good quality group of investment banks. It's not the largest group you're going to find at a conference, but having known many of these investment banks and worked with them over the years, it's a very good quality group.
So do you get private equity funds and those kind of folks attending these things like they would perhaps, the Association for Corporate Growth when they do their capital event every year, but there's really no companies at those events, and this has got a lot of companies. Or are they operating in two different ethospheres, that the funds that are here are not the same that would go for leverage buyouts or those kind of things?
So the Association for Capital Growth is kind of interesting because it's basically buyout funds and the investment banks that locate the companies to be bought. And while growth is in the Association for Capital Growth's name, it's not really a lot of growth capital. I mean, there are a couple banks like Castle Scepter that provide growth, and there is Mark Foster with his firm, which has got a tremendous track record of backing startups. But when you think of private equity's traditionally meant a buyout shop. When I was younger, we used to call those leverage buyouts LBO shops. Now they're called private equity. Private equity is either going to take over a poorly managed public company, which is, they feel they can fix and make more valuable, or it's going to buy somebody's privately held business because they feel they can get it at a cheaper multiple than that business would be as a publicly traded company. The funds at this conference are more of a hedge fund style investor. So when I say they're hedge fund style, there's a big difference between private equity and hedge funds, and that is in the payment structure. Most private equity funds have a fixed life, and the managers of those funds get paid out their carried interest only after the original capital is returned to those investors, where hedge funds get paid on a quarterly and annual basis because of the liquidity they provide. But there were family offices that are long-term stable investors, and then the funds at this conference are more of a hedge fund type fund, but you can think of it as also there's about 500 miniature Warren Buffetts running around that conference.
Okay.
And
All
that's what
right.
they talk about
I
is
see.
the you know uh, I'm drawing a blank, but Benjamin Graham style of investing.
Okay. So now you went on at the first week of May to the Bank Holding Company Association conference. How is that different?
So I went to the Bank Holding Company Association conference, and the group is based out of Minneapolis, Minnesota, and it's comprised of about 140 bank holding companies across the Midwest. Um, and I went up there on behalf of Mountain Share Transfer, my stock transfer agent, and that is kind of they get together and they discuss regulatory items and they discuss the economy and other things of interest to the banks. And what you learn is there's a lot of very well run small commercial community banks out there, and you get to see what their take is on things. And there was some very interesting presentations on the economy, the state of the economy, where people think it's going in several years. And then one of my favorites is about how these banks, some of which are incorporated or based out of really small towns of less than 5,000 people, have managed to grow and thrive in areas that people would not think that would be occurring.
Oh yeah. That's so they're not just dependent on the deposits of the local community then if they're those kind of banks.
Well, they do get local deposits. They also make a lot of local loans, and what you find is so one of the more interesting ones was a small bank created a consulting division to help its clients better advertise their products, and then that division also helps their the borrowers, the companies the bank loans money to actually run better and be more profitable. And as a result of that, the bank was able to grow its deposits because the consulting firm did not provide advice to non-bank customers, and rapidly expand the bank by over tenfold in a period of about as many years.
Yeah. Okay, so let's get into recap of the episodes now. Are the episodes for the Capitalist Conversations all live now out on Spotify and Apple, or are they still getting pushed out?
I need about another week to get them live because I'm done traveling. It was a brutal schedule. 2 conferences in 3 weeks is not an easy feat, for most small businesses. Um, but yeah, what I want to do is let's take a recap of things, and if I can, I want to share my screen here because what we're going to get into is what I like to call the capital raising ladder, and that is a kind of moving up the food chain for raising money and how investors should be taking a look, or business managers should be
Yeah.
taking a look at it. And you can see on the screen here, I've put up a inverted pyramid. And when businesses go out there, they're typically started, the founder puts up some money. And then as they move beyond the founder, they get to friends and family. They move up the food chain traditionally to angel investors and then venture capitalists before going public. And finally seeing the, private equity firm possibly take them over as a public company. And you can see the size of the capital that can be accessed through these traditional routes. Angel investors are believed to collectively invest about $29 billion into companies on an annual basis here in the United States. The venture capital industry is about 6 times as large, about 5.5 times as large at $170 billion. And that's spread out among, I believe, 3,500 venture capital firms in the United States. And then in the public markets, the value of our publicly traded securities is $14 trillion, counting the New York Stock Exchange and the NASDAQ. And then private equity worldwide is about $8 to $10 trillion.
Yeah.
And what I was hoping to do is kind of tie this all together as to how what we're doing is helping business owners and entrepreneurs understand when they want to raise money, what the path is to successfully raise capital and grow their business.
Yeah.
So that
Okay. Well, that was so our first episode was talking about the purpose of the capital markets. And so anybody, listening to this now, you can go back and check out these shows that we're highlighting. But that was the purpose of the capital markets. And that is, really to create liquidity across the board. So, all of the capital that you just talked about, those buckets, they're investing so that they can get a return on that investment, and then for turn around and put it back into investments, create the jobs. It's the startups as they grow that create the jobs. And, so that's, wouldn't you say that was pretty much the whole purpose of all of those different things you just talked about? It's really just fueling the economy, because that's where the majority of capital for growth of companies comes from.
Yeah, I mean, we have got the greatest economy in the world and most successful economy in the world because investors and entrepreneurs can get access to capital. And the capital markets provide, not only do they provide that access to the capital, but what they do is they provide the early investors an opportunity to recoup their capital through the exiting of their investments. They also provide, in an efficient market, they provide a form of price discovery, which is basically saying, what is this business really worth? And, we have a variety of metrics, price to earnings ratio, price to cash flow, things like that help us out with that.
Okay, and so then we moved on in episode that going into that next month. We overviewed IPO, the initial public offerings. We did a high level of all the different ways that a company can go public, and there's a whole lot that people don't know about. There's the one that gets all the press is the straight up IPO, but besides a Reg A plus that can take you into a small cap, Erik reviewed all the different other ways, SPAC, all these different things that you can do, and then we dug into it and all the difference between the platforms, the different listing platforms in episode 3, and then we had a guest in episode 4, Richard Krieger, and he runs an investment bank, and I guess we were talking about rights offerings. Do you want to recap any of those those first kind of in a nutshell what we covered in that series that we did there?
Yeah, well, what we did there is we started off with IPOs and public markets because that is what most people are familiar with when they think about raising capital or for their company and growing their company. A lot of people think that the public markets, that is their default thought. We looked at the alternatives for getting public and where you could raise money along that life cycle. And then we interviewed Richard Krieger. He runs Moody Capital. Richard is a longtime advocate and investment banker advising companies on rights offerings. And I think for your small and microcap companies, I think Richard Krieger is probably the foremost authority in the country on how to do those and do successfully.
Explain real quick what rights offerings are for people that aren't familiar.
Basically, you are offering to your existing shareholders the ability to buy stock in the company at a fixed price. So, for example, if you have a publicly traded company or you even a privately held one with a lot of shareholders, you can issue a rights offering that says, for example, for every 5 shares you own, you have the right to buy 1 new share at $10 a share, $15 a share, whatever the price is you determine, and whatever the ratio is you determine. But for example, if you have 1,000 shares, you could buy in our situation 200 new shares. And you generally get a pretty good participation rate. Those shares are registered through an offering document. They're free trading, and the investors, it's a chance for them to further support a company they already believe in, and it's a way for the company to raise a stable capital.
Okay. And so that would be that was a great episode, and it would be so good for people to go back and listen to and watch that on Spotify. You can watch the video just like you are now on our live stream. And then we went into IPO preparedness, and we got into really the nuances of having, and I think Richard's touched on this some too, just the challenges of, not having proper financial statements, not having, the type of scrutiny that you might go through, making sure just all the, your house is in order before you start that process, because it can cost you a lot and delay your going through the process if you're not prepared, right?
Well, yes, and then one of the other important things is when you look at what it means to be prepared for an IPO, or get ready for an IPO. Those things are not just relevant to initial public offerings. If you want to raise money from angel investors, if you want to do a Reg A and do a crowdfunding, or just do it as a traditional private placement to people or network with, or your business's customers, the work that goes into preparing for an IPO is the foundation of good corporate governance. When I was on the panel in Las Vegas, my advice to everybody in the room, all the companies that were there listening, and everybody else is, I looked at them and I said, the most important thing is always to be prepared to raise capital. And what that means is you've got the corporate governance, you've got your documents ready, you've got a business plan, you have an investor presentation, and you have due diligence. You have proper due diligence so that the investment bank can come in and evaluate quickly whether or not the company's suitable to finance. And the reason we did IPO preparedness is that kind of lays the foundation of what needs to be done on these other steps we're going to talk about.
Yeah, and I think, it would be useful as we roll into this next segment of shows we talk, we're going to connect the dots so that people understand what we've been talking about on the public markets, but then how you get started, from angel to crowdfunding all the way through that process. Due diligence is so important all along the way. And I think sometimes I don't think entrepreneurs really understand what due diligence is. I mean, I cover it in my book for angel investors and in my book that's coming out for crowdfunding investors on, what you need, the kind of questions you need to ask, the kind of documents that need to be available in a deal room. Sometimes you hear about them in deal rooms. It's basically a secure access where documents are, held confidentially for people, interested investors, to be able to look at them. And so the kind of information, because that's where deals fail. At the top level, you have, here's all the stuff we're going to do with the money, and here's how you're going to make your money back, Mr. Investor. And then and even when they agree on stock price, they agree on those kind of terms, they get into due diligence, and things I've said so many deals fall apart at the in the private company thing because of lack of due diligence. And the thing is that entrepreneurs, it's sometimes it's really hard to get entrepreneurs to actually do a financial forecast and a business plan until they need to go raise capital. But that's part of being ready, like you say, Eric, is that you need to have these documents that you're keeping updated. And they'll be like, what do you mean due diligence folder? I remember back before we did the electronic deal rooms, and I was doing the big one for one of the companies in the angel group, and he had to do a 3-ring binder, right? So it was like this 3-ring binder that was separated, and it had your marketing strategy, your competitive analysis, it had all of these different tabs. And I said, half of the due diligence process is knowing that you have prepared the documents. They may not look at every document in there, and each investor is going to have a different sweet spot of what they most care about based on whatever they've experienced in the past. And so the fact that you've gone to the trouble of doing that gives them confidence that you are doing all the things you need to be able to scale. And so now you can do it electronically and keep those, you don't have to have a 3-ring binder that people come to your office to see.
Yeah. I mean, in the share file, Dropbox, and the other, entities out there have made that process a lot easier. About 15 years ago, FINRA, the Financial Industry National Regulator, came out with a series of a guideline on what it expected to see in due diligence on private placements. And that was Regulatory Notice 1022.
You just pulled that out of the top of your head.
No, I know that well, and I know that well because Coral Capital has done due diligence reports in accordance with the FINRA guidelines of 1022, and there's additional information on that on our website at coralcapital.com under due diligence. But it's a pretty comprehensive and exhaustive list, and the reason that FINRA came out with this guideline was because there were some investment banks, and I think one in particular out west, and it raised, I believe, $6 million for some fraudsters who stole the money and ran. And FINRA said enough's enough. And I know of another investment bank that some friends worked at that they did not do their due diligence, and it turned out that the client didn't even have a lease on an office like it said it did.
Some of these things are so common sense. You're like, yeah, and it happens all the time, even with the best of investors. That's why you just got to always you can't assume I've asked all the questions. You got to go back to your list. I mean, I have a due diligence checklist in the book and in the resource portal that comes with that in the digital course. And, and when I would give that to entrepreneurs that are raising capital, I'm like, not all of this applies to you because some of it deals with public companies, some of it deals, but you need to go through, make a note. Is this something that I need to worry about? And if it is, then you go and you figure out putting your stuff together, or you have an explanation as to why you don't have that particular document, because not all the investors are actually going through that same checklist. You want to be, part of a public company versus a private company is that a public company has this obligation for transparency with their filings with Edgar and with the SEC, whereas private companies don't have that same obligation to, put it out there in advance, right? They need to be transparent, and they need to be, because if you don't disclose stuff that could derail the company, then it's a material fact that you have withheld in your private placement memorandum or everything that could then lead to charges of fraud if it ends up derailing the company and the investors invested without knowing that information. And so, being forthcoming is always better. And I tell the investors, you have the right to ask for every piece of information that you want to get access to in order to make that investment. And if a private company balks at that, then leave. There's lots of options. There's plenty of other places to make your money and put your money to work. You don't need to be investing in a company that has got all the sizzle of the steak, but, no bone, right? And so, that's just one of those big things that we'll do a whole episode on that coming up, and as we stitch this together. So anything else you want to add about due diligence, or let's talk about what we covered as an alternative to IPO?
Well, the final thing I'll add is, when you have an outside firm that does due diligence, they should prepare a report. So, for example, when we've done this, we've prepared reports that are on average about 30 to 40 pages, not counting exhibits. Whereas, for example, in our, as we previously talked about a company not having a lease, we can say we have reviewed the lease and confirmed that it's valid. Or we did a project on a luxury dinner theater. There was an appraisal. Did we evaluate the value Valuation of the appraisal, no. But did we look to see that the appraiser was a licensed and certified appraiser? Yes. And those are the things that you should be able to get. I mean, if a guy says, well, we've got 5 locations, does he have leases on 5 locations?
Yeah.
Or what's the status of it? And this all kind of ties back, because when I was at Planet MicroCap, those are the guys that are digging in and doing the homework. Those are the heavy duty analysts. Those are the guys that are looking for the diamond in the rough, and they're out there. And if you got a good business, you can attract them, because that's what they're looking for, is a good business versus a poorly run business.
Yeah, absolutely. Okay, so we went into one of our, real sweet spots, and the thing that we really want to help growing companies that are poised for growth to unlock capital that they can't get from their angels, from their VCs, because they're in a different industry. They're, they didn't start raising capital in a timely manner and kind of got stale and plateaued, but they got new products they want to bring out. They've got an acquisition they want to do. They want to do a very aggressive rollout of a franchise concept, whatever it might be that they're trying to raise capital for. And they're too big for angels, not the right fit for VCs, too small for private equity funds, perhaps, or they don't want to, buy out that way or have that kind of thing. Going to the crowd, general soliciting the general population, and for your capital under a Reg A plus or some combination of Reg A and other, leading into it, like that is a great way to set the stage for an exit for your existing shareholders and new shareholders, when they complete the filing and they're out on the exchange. And it's something that is so little known. There's just not enough companies that know about it, not enough investment bankers that know about it, just not enough people. So a big part of what we do this show for is to make companies and investors aware so that they can look to us or somebody to help them explore whether Reg A Plus is right for them. So we did 2 episodes on that. One was raising capital specifically on Reg A Plus and what was that like and how do you go about it? How do you prepare? And then we had Michael Littman in as a special guest, who is a lawyer that has done a lot of these. And man, was that a great episode of him talking about the pros and cons, the good, bad, and the ugly, the things that people have done right, what they've done not right, the impact that it had. It was a really great, both of those were good episodes, and the interview with Michael Littman was really good.
Yeah, I've known Mike for 20 years and worked with him closely on a regular basis. I think one of the most important things is when there's always been a question, can an already public company do a Reg A or a crowdfunding? And Mike came down with a definitive yes, that if you're publicly traded, you have the ability to go out and do a Reg A or do a crowdfunding. So that opens up a lot of doors for companies that are struggling to raise capital, because if you can put together good solid management on your business and you can raise the money, you can solve almost any problem you have.
Yeah. Yeah. I mean, you can't. That's like kind of the chicken and the egg, right? If you can do this, then you can raise the money, then you can solve the problem. But you got to have a strategy of how you're going to solve the problem with that money, because investors, particularly if you have a story you're kind of plateaued, what is it that the lessons learned? The third book, who knows when it's going to be out, hopefully by the end of the year, knock on wood, is how to scale your business and get the money to do it when the banks, angels, and VCs say no. And that's all about that introspective of why did you not grow? Why did you not raise that other round of cap? What mistakes did you make? What aha moments did you have? And what do you have to do to prepare so that you can scale? A lot of times companies desire that, but they don't know how they're going to go from making 10 widgets a week to 100 widgets a week. They don't have the strategies in place. They just want to throw money at it and solve the problem. And investors want you to know what you're going to do with their money. They don't like you to be in a sandbox figuring things things out with their money, because you may not have raised enough money, and that might be the reason why you're in the problem. Had you known what you were going to do with the money to begin with, you would have raised enough money to get you to that next point. So you got to know exactly what you're going to do with the 10 million that you might raise through a Reg A plus. That's going to lead you into creating a bigger market cap that either goes to an acquisition or to an exit on the stock exchange.
Oh yeah, most definitely. And then after that, in our last episode we did, episode number 8, we took a look at the career of Sig Mosley, a local investing legend here in Atlanta. And Sig is one of the most successful angel investors I've ever come across in my lifetime.
Yeah.
We went to his honorarium back on the 29th of April. And one of the things they talked about is that throughout his career, Sig had 82 exits, and only 2 of them were IPOs.
Right. We always tell people the odds are you're going to get acquired before you do the IPO, because the IPO is such a bigger thing. And, it's amazing. And the other thing about that, it was like, what was it, 70%? 80% of his investments ended in an exit like that. And that's like that. The rate of success on him being able to discern a company, getting in early and growing is just phenomenal, man. If you could put that in a bottle, you could like sell a whole bunch of that to people, because it's a learned knowledge and an earned knowledge. But he definitely, he's been doing it for 3 decades, so he got really good at it. But he was also, he was one of those that also didn't get all caught up in like when one of his early stage companies, there was these founders on stage that I knew them now, like in the last 10 years as angels or fund managers. And I learned that night that their first companies that they got the big exit on, he was a seed stage investor in that. And when they needed to make payroll, he would be like, they would call the phone. They go, hey, I got this money coming in, but I got to make payroll the next 2 weeks. And he would say, how much? And then they would pay him back. So he was the private bank for them a lot of times without a whole lot of terms or conditions or anything like that. He just wanted to see the company succeed. And like you said just a few minutes ago, Erik, when you've got the capital to get you over that hump and you're able to invest in the company as a founder to do whatever the marketing is, hire that key resource, buy that product, pay for this contract, till money comes in, you can continue your momentum. And when you don't have that momentum like that, it becomes really challenging to continue to grow. And I think part of his success was he helped those companies continue to grow till they got their own momentum and could get the other bigger money to come in.
Yeah, I mean that's clearly one of the keys to success. I mean, I did the quick math. 97.5% of his exits were through acquisitions, and that implies an extremely good talent behind the scenes.
Yeah.
The other thing everybody talked about was Sid, which I think is a very key. But it's a key skill that not enough people have. Is he returned all the phone calls. He called everyone. He talked to everyone.
He did.
He would
meet with
talked
everybody.
to me, and he talked to and I've never done a deal with Sig. But what I wanted to do and what I thought was important is we need to take a good look at angel investors and how attracting angel investors and treating them right, knowing what they want, and working with them, how is a good key to help make your business successful.
Yeah. Yeah, absolutely. And and it should he has this joke. There's a joke that was very prevalent, t-shirts on it, that says Sig said no. So even though he had all those successes that we just talked about, right? He averaged 1 yes to 99 no's or something like that. He it was a badge of honor to get a no from him. And sometimes his no's became yeses over time. But, he took the meetings. He was able to get to the value proposition very quickly. And he didn't waste time dragging the feet with a founder on whether he was going to say yes or no. He got to know pretty quick, but he got to a lot of yeses. And, and the one they were doing the 25th anniversary was his really big, huge exit that he had with the one company 25 years ago. But, I think ISS and Internet Security Systems, that was a huge deal, but it was an acquisition by IBM, even though it was I don't know how many hundreds of millions of dollars they bought. It was like $600 million or something like that.
It was $3 billion. I thought it was $3
billion. It was like such, so he was an investor that had the multiple on that, and that was an acquisition too,
Yeah, and what I remember reading about Sig was he would tell people no, but he would tell them also what he thought they needed to do to get to yes. He would give them good quality feedback of I find your business interesting, but I think you need to get X, Y, and Z accomplished before it becomes investable. Not, and so even if he didn't put in the money, he kind of gave him the advice to go get the money from someone else.
Yeah. Yeah. So we're hoping to get him on the show here in the next couple of weeks. He's a busy man, although he is going into his retirement. So who knows if he's going to jet off on some world travel trip or something like that, and we can't get to him. But we're gonna hopefully get him on the calendar to do that. And as we start those pyramids that Erik showed, we're going to connect the dots, paint the picture for you, because as we segue into talking about that, one of the things is that there's a lot of, you're listening to this show now, you probably have some anxiety about what's going to happen with the capital markets, what's going to happen in the economy. I mean, it has been just stunning. I saw an article about Bank of America saying that nearly $8 billion was pulled out of the U.S. markets in 1 week, and a lot of it going to the foreign markets. But we've seen the foreign markets also tank in this flux that's happening because of the uncertainty over tariffs and all of those kind of things. So it is a great opportunity if you're taking your money out of the public markets to not just let it do is some low interest rate in a money market or in a CD or something like that, but put it to work with these entrepreneurs that are bringing innovation to the market, creating jobs, and growing a business from zero to 1,000. From 0 to 300 billion, right? And in another year or two, everything's going to be back in a growing mode. And we're going to, assuming, things get on track. But even then with the acquisition, as we just said, you don't have to be dependent on what's happening on the capital markets. If you're investing in things that you understand, that have good potential alongside other investors, put your money, and we're going to talk about that, get the book, Inside Secrets to Angel Investing. Start thinking, if you're not familiar, have you ever thought, angel investing's gambling, whatever? Millionaires choose to put their money to work. Somebody like Sig Mosley took what he had and probably 10x'd it at least, or 100x'd it overall in his portfolio. His fund itself for seed state was $30-something million. So, he has, because he chose to put money in private companies, and anybody can do that. And with crowdfunding as it is now, you don't even have to be a millionaire to be able to get started investing in these kinds of opportunities. So we're going to pull all of that together and start explaining that in greater detail next week. And I think you were going to talk about the SEC had, I don't know if it ties right into this, but there was a press release by the SEC about building wealth. Investors power the U.S. economy, because they absolutely, it is, and I talk about this in my story. When I left IBM to go and take over got introduced to NBA9, and then ultimately became the managing director of that. I didn't know about it. I was working with venture capital and banks, and I didn't know about angel investing because before the Jobs Act, it truly was like a secret society. To get invited into the angel groups, to get invited to look at the deals, you had to know someone. It was just not, there's never been word of mouth out there like there has with any other type of investment asset class. It's always been something that's been kind of elusive. And crowdfunding is rapidly gaining given how old it is compared to angel investing, but it's still something that a lot of people don't have any idea about. So we're changing that story. Anything you want to add about the role of investors in the economy, or you want to talk about the SEC Small Business Advisory that you found?
Well, the SEC did have they have a small business advisory committee on capital formation. I will post some information on it on our Capital Conversations webpage at sterlinginvestments.com. And they do take raising capital for small businesses very, very seriously, and they do understand that it is difficult, and they are making moves, and they solicit investor comments, they solicit business owner comments, and they want to know what you're seeing and what you think could be done to improve the situation. The SEC published a article. You'll find it on my. I'm going to put it out on Twitter, but they had a article on their 10 building blocks to building wealth, and I reviewed them, and they make very good sense, very very much common sense. They talk about diversification, doing your research, doing your own due diligence on things, and avoiding FOMO, fear of missing out.
Yeah.
There's a few more of those. I think we're up on a little bit on our time today, but. And they talk about starting early, but angel investing is a key to this long-term strategy. So it's one I really looking forward to our deep dive through the rest of May with our production schedule and into June. So we'll be on for most of June except for the week I'm at Boy Scout camp. So
Okay.
which is its own adventure, So I'll have some good stories.
Yeah, that's you said that was the first week in June, or right, because
June 9th, I will be at Boy Scout camp
okay.
up at Camp Rainy Mountain here in northeast Georgia.
Yeah, so I think I'm running that show solo. We'll get somebody on there to interview on that part when we get there. Maybe we'll talk about it.
All right.
You should be involved in merger acquisitions, but we'll figure something out. We'll get a good person on that. Talk
Yep.
about crowdfunding or Reg A plus or raising capital on that front. So all right. Well, so please make a point. We're doing this every Tuesday here on LinkedIn. You can, pencil in your calendar. We do want to get questions. Add a question to wherever this post you see it. If there's a topic you want us to cover in the future, and we will fit it into the schedule and let you know. Because we're providing information for you to be able to make good business decisions, either as an investor or as an entrepreneur, to avoid the pitfalls that cause unnecessarily for companies to lose value or to get into trouble with the SEC in some way. And the best way for us to continue to provide exactly what you're looking for is for you to tell us what you're looking for.
Yep. So please reach out to us and let us know your questions and what you'd like to see.
All right, then. And with that, we say onwards and upwards. Have a great day and a good rest of your week.